Corporations might issue certain instruments that allow the purchase of stock rather than the stock itself. Stock rights are given to shareholders when new stock is issued, allowing shareholders to take advantage of their preemptive right to maintain their proportional ownership. Stock warrants are sold with other securities, such as bonds or preferred stock, in order to make the security a more attractive investment. Stock options are granted to officers and employees of a corporation, usually as part of a compensation plan. Warrants are either detachable or non-detachable. If a warrant is detachable, it can be sold as a separate instrument, separate from the bond or stock to which it is attached. On the other hand, if the warrant is non-detachable, it can't be separately sold. If warrants are detachable, they are recorded as equity in the financial records. To do that, the value for the warrants needs to be determined. Presented here is the formula to determine this value. We take the total issue price of the bonds or stocks being issued, including the warrants, and multiply it by a ratio. This ratio is the market value of the warrants, which can be determined just after the warrants are beginning to be traded in the market, and divide that by the sum of the market value of the security being issued without the warrants and the market value of the warrants determined for the numerator. As an example, Stewart Company sells 1,000 shares of $50 par preferred stock for $58 per share. This means the total issue price is $58,000, which is 1,000 shares times $58 per share. Stewart Company gives the purchaser detachable warrants enabling the holders to subscribe to 1,000 shares of $2 par common stock for $25 per share. Immediately following the issuance of the stock, the warrants are selling for $3, and the fair market value of a preferred share without the warrant attached is $57. First, we calculate the value assigned to the warrants by plugging the amounts given in the example into the formula. We arrive at $2,900. Keep in mind when using this formula, the ratio is using per share and per warrant amounts, whereas the amount multiplied by the ratio is the total issue price of all the shares being issued. To record the entry of the issuance of the preferred shares and their detachable warrants, begin with a debit to cash for the total issue price of $58,000. Next, credit the preferred stock account for its par value, which is $50,000. An equity account called common stock warrants is credited for the amount we determined using the relative fair value formula. Finally, the difference, to balance the transaction, is credited to paid-in capital in excess of par. So now there's a bunch of warrants being traded. Recall what a warrant is. It allows the warrant holder to turn in the warrant to purchase common stock. In this example, it allowed the warrant holder to purchase a share of common stock for $25. These warrants come with an expiration date. If the warrant holder makes the stock purchase by the expiration date, the warrants are said to be exercised. If not, the warrants are said to be expired. If the warrants are exercised, the transaction includes a debit to the common stock warrants account to close it out. In this example, all the warrants were exercised, so the debit is for $2,900. However, if only some of the warrants were exercised, we need to calculate the amount of the debit. This is easy. Remember, warrants were recorded at $3 each, so we just multiply the number of exercised warrants by $3. Next, we debit cash for the amount of cash received. In this case, all warrants were exercised, and each warrant allowed the purchase of one share of common stock for $25. If there is 1,000 warrants, then 1,000 shares were purchased. This amounts to $25,000. Next, we record the credit to common stock for the issuance of the stock, and a credit to paid-in capital in excess of par for the remainder. So what happens if the warrants expire? They become worthless to the warrant holder, and the corporation still has a common stock warrants account with a $2,900 credit balance. Since the warrants can no longer be exercised, the corporation removes this balance from the books by debiting the common stock warrants account and credits a paid-in capital account specifically for expired warrants. Share-based compensation plans are those in which the corporation grants stock options to its employees. The value of these options is recorded as compensation expense over a period of time from the grant date, which is the date the corporation grants the options, to the vesting date, which is the date the employees may start exercising the options. In this example, Neff Company grants 10,000 options to its employees on January 1st, 2013. The options permit employees to purchase one share of stock for $50. Neff Company estimates the options have a value of $10 on the grant date. While the value of the options may change after that, this initial valuation is the one to be used for all transactions concerning these options. The total fair value of the options granted is $100,000. The total compensation expense for the 3-year period is $100,000. At the end of 2013, the corporation recognizes a portion of this compensation expense. The amount is the total value of the options, as was determined on the grant date, divided by 3. The adjusting entry includes a debit to compensation expense for $33,333 and a credit to paid-in capital from stock options. A similar entry is made at the end of 2014 and 2015, so the entire value of the options has been expensed. On December 31st of 2016, the employees exercised the options and purchased 10,000 shares of Neff's no-par common stock for $50 each. The entry includes a debit to cash for the amount received, a debit to paid-in capital from stock options of $100,000, which reduces this account to zero, and a credit to common stock of the total, $600,000. The previous example of stock options involved a predetermined quantity. However, sometimes the quantity of options granted will be dependent upon certain performance criteria. On January 1st, 2013, stock options are granted to employees permitting the purchase of one share of Neff common stock at $50 per share. The options vest on January 1st, 2016, and only if the employee stays with the company for the entire 3-year period. The number of options granted is contingent on Neff's level of sales for 2015, the last year of the vesting period. If Neff's sales are less than $50 million, 10,000 options will vest. If Neff's sales are between $50 million and $80 million, 12,000 options will vest. If sales exceed $80 million, 15,000 options will vest. At the end of 2013, Neff forecasts that 2015 sales will be around $60 million, indicating that 12,000 options will vest. To recognize compensation expense for 2013, the value of the options, which is 12,000 times $10, is divided by 3 to arrive at $40,000 to be expensed that year. In 2014, Neff forecasts 2015 sales to be only $40 million, which means only 10,000 options will vest on January 1st of 2016, a value of $100,000. 2 of the 3 years of the vesting period have passed, so 2/3 of the option value should be recognized. $100,000 times 2/3 is $66,667. Since $40,000 was recognized in the previous year, only the remaining $26,667 is to be recognized in 2014. Actual sales for 2015 are $85 million, so 15,000 options will vest on January 1st, 2016, a value of $150,000. All 3 years of the vesting period have passed, so all of the option value of $150,000 should be recognized. Since $66,667 was recognized in the previous years, only the remaining $83,333 is to be recognized in 2015. On December 31st of 2016, the employees exercised the options and purchased 15,000 shares of NEF's no-par common stock for $50 each. The entry includes a debit to cash for the amount received, a debit to paid-in capital from stock options of $150,000, which reduces this account to zero, and a credit to common stock of the total, $900,000. Stock appreciation rights may also be granted to employees. These rights award an employee a cash amount equal to the market value of the issuing company's stock above a specified threshold price when the right is exercised. In this example, NEF Company grants 10,000 stock appreciation rights to employees on January 1st, 2013. The stock appreciation rights vest on January 1st, 2016. As of December 31st, 2013, the estimated fair value of each stock appreciation right is $6. The best estimate of the amount of cash that will be transferred when the cash stock appreciation rights are exercised is $60,000. Compensation expense is recognized in 2013 with a debit of $20,000, which is 1/3 of the estimated amount of cash to be transferred once the stock appreciation rights are exercised. Recall the definition of a liability, in which a future transfer of assets or services as a result of past transactions or events must be present. This is such a case since the past event is the employee's service to the company, and the future transfer involves cash, an asset. Therefore, the credit in this transaction is a liability called share-based compensation liability. It's presented on the balance sheet with other liabilities, not in stockholders' equity. In 2014, the estimated fair value of each stock appreciation right is $7. The new estimation for compensation expense is $70,000. 2 of the 3 years of the vesting period have passed, so 2/3 of the stock appreciation rights value should be recognized. This is $46,667. Since $20,000 was recognized in the previous year, only the remaining $26,667 is to be recognized in 2014. In 2015, the estimated fair value of each stock appreciation right is $9. The new estimation for compensation expense is $90,000. All 3 years of the vesting period have passed, so the entire value of the stock appreciation rights should be recognized. Since $46,667 was recognized in the previous years, only the remaining $43,333 is to be recognized in 2015. On December 31st of 2016, the employees exercised the stock appreciation rights. On that date, the share price is $61, so the value of each right has gone up to $11. Previously, $90,000 had been recognized as compensation expense, but due to the increase in price, compensation expense must again be adjusted. The new total compensation expense is $110,000. Since $90,000 has already been recognized, this year's entry would include the remaining amount of $20,000. Then the payment is made to the employees for all of the rights that were exercised. Here's some practice problems to try from the textbook found at the end of the chapter. I recommend you pause the video now, work the problems, and then resume the video to see the solution. Presented here is the solution for practice problem 13.8. It follows the example presented in the textbook. You may need to pause the video now if you need to review the solution. Presented here is the solution for practice problem 13.9. The total compensation is the quantity of options multiplied by the fair value of the options on the grant date. The compensation expense is recognized equally over 3 years with an adjusting entry at the end of each year. When the options are exercised, The paid-in capital from stock options account is closed out with a debit. Cash is debited for the amount the employees paid for the stock, and the appropriate credits are made to record the issuance of the stock. Presented here is the solution for practice problem 1310. Each year, the total probable compensation expense is determined, and adjustments are made to bring the compensation expense up to the proportional amount it should be for the amount of time that has passed. Pause the video to review the solution in detail if you need to. Here we have the solution to practice problem 1311. Accounting for stock appreciation rights is similar to that of performance-based stock option plans because the estimated value of the rights is recalculated each year, just as the estimated value of the options was in the performance-based plan. Each year, an adjustment is made to bring the compensation expense up to the proportional amount it should be for the amount of time that has passed. The significant difference is that the credit is to a liability because cash will be paid, whereas in the case of the option plan, an equity account was credited. So remember, stock appreciation rights result in a liability, options result in equity. Now we turn our attention to items that have characteristics of equity but are reported as liabilities. The first are mandatorily redeemable preferred shares. These are much like a loan in that the shareholder must redeem the shares for a specified amount. The corporation has an obligation to pay that specified amount on a future date. Here's an example. Tarazi Company issues one mandatorily redeemable preferred share for $100. It is to be redeemed by the shareholder 1 year later for $110. The additional $10 is considered to be interest. The corporation records the issuance of the share with a debit to cash and a credit to a liability account called mandatorily redeemable preferred shares. On December 31st, the corporation accounts for accrued interest with the adjusting entry that includes a debit to interest expense and a credit to mandatorily redeemable preferred shares. Finally, on the date the share is to be redeemed, the corporation debits the redeemable preferred shares liability account to close it out and credits cash. Another financial instrument that has characteristics of equity and debt is a put option. A put option is an agreement that allows investors to sell the issuing corporation shares they hold at set prices on specific dates. This is at the option of the investor. As an example, Camilli Company wrote a put option in which it agrees to purchase one share of its own stock for $100 in 2 years on December 31st, 2014. The option has a fair value of $20, so Camilli records a debit to cash and a credit to a liability account called put option of $20. Remember, this isn't stock being issued, it's just an agreement, and this agreement is valued at $20. At the end of 2013, the option is revalued and found to be worth $30. At the beginning of the year, the liability was recorded as $20, and now it's $30. So the corporation records this as a loss with a debit to a loss account and a credit to put option, which increases the liability to $30. At the end of the year, the market price of Camilli stock is $82. Since the purchaser of the option would receive $100 to sell back one of its shares, of course the purchaser decides to exercise the option. The corporation takes back the stock, recording this with a debit to treasury stock. Using the cost method of accounting for treasury stock, this would be done with a debit to treasury stock. Then the put option liability is debited for $30, reducing that liability account to zero. Cash is credited for the amount paid to the put option holder. The difference is credited to gain on put option. This $12 is determined by comparing the amount in the liability account of $30 with the actual value of the option upon its expiration, which is $18, the difference between the $100 to be paid and the price of the stock. This is similar to accounting for the options granted as part of a performance-based compensation plan, except that gains and losses are recorded each time the options are revalued. Finally, we have the obligation to issue shares. This might occur when a company needs services and agrees to pay the value in shares instead of cash. Two scenarios can occur. The company might agree to issue an amount of shares that equal a certain dollar value, or a company might agree to issue a specified number of shares, the dollar value of which can't be precisely determined on the agreement date due to the potential for a change in value. In this first example, Lilly Company agrees to deliver 200 shares of no-par common stock to a repair person on February 1, 2012 for services valued at $5,000. The shares on the date of the agreement have a value of $25 each. Lilly records this with a debit to maintenance expense for the expense of the services that were provided, and a credit to an equity account called Common Stock Issuance Obligation. This is recorded in an equity account because the value of the shares in the future is uncertain, but what is certain is the quantity of the shares to be issued. Stockholders' equity is increased with this transaction. On February 1st of the next year, the actual shares are issued to the repair person, which is recognized with a credit to common stock, and the common stock issuance obligation is decreased to zero with a debit. Total stockholders' equity has not changed on this date because the issuance of the actual shares simply replaced the obligation. In this second example, Lilly agrees to deliver shares of Lilly's no-par common stock with a market value of $5,000 to the repair person on February 1, 2014. This is similar to the previous example, except the company can't be certain what quantity of shares will equal a value of $5,000. The shares have a market value of $25 on the date of the agreement. On the date of payment, the shares have a market value of $20. This is important because it will determine the number of shares that will need to be issued on that date. The company records this agreement with a debit to maintenance expense of $5,000, just like in the previous example, but the credit is to a liability account called Common Stock Issuance Obligation. This results in an increase in short-term liabilities, but no effect on equity. On the payment date in the next year, the liability is reduced with a debit, and the stock is issued recognized with a credit. The quantity of stock is 250 because Lilly agreed to issue stock with a total value of $5,000. Dividends are paid to stockholders as a return on stockholders' investment. A company's board of directors determines whether or not dividends will be paid. Different accounting procedures are followed for different types of dividends. Before we review those types, it's important to be familiar with the 3 dates involved in the process of paying dividends. The date of declaration is the date the board of directors announces it will pay a dividend. On this date, a liability is incurred and recorded in the accounting records. The date of record is the date stockholders are identified. This is essentially a matter of creating a list. Nothing is recognized in the accounting records on this date. Finally, the date of payment is the date the dividend is paid or distributed. On this date, the liability created on the date of declaration is reduced. A cash dividend is one type of dividend. In this example, a $100,000 cash dividend is declared. On the date of declaration, retained earnings is reduced with a debit, and the dividends payable liability account is credited. This dividends payable liability account is a current asset since the dividends are usually to be paid within 1 year and involves the future payment of cash. On the date of payment, the liability is reduced with a debit and cash is reduced with a credit. Another type of dividend is a property dividend. When accounting for a property dividend, the carrying value and the market value of the property on the date of declaration must be considered. In this example, Bigler Corporation owns, as an investment, 100,000 shares of Tri-State Oil Company. On Bigler's books, the investment has a carrying value of $2,700,000. However, The Tri-State Oil Company shares are currently trading at $30 per share, so the market value of Bigler's investment is $3 million. This means Bigler will recognize a gain on disposing of the shares as a dividend. Gains and losses are recognized when assets are disposed. On the date of declaration, retained earnings is debited for the market value of the investment shares. A current liability account called property dividends payable is credited for the carrying value of the shares, and the difference is recorded as a gain. The payment is recorded with a debit to the property dividends payable account and a credit to the investment in Tri-State Oil stock. Finally, we have a stock dividend. A stock dividend consisting of less than 20 to 25% of the outstanding shares is considered a small dividend. In the journal entry for a small dividend, retained earnings is debited for the market value of the shares on the declaration date. A stock dividend consisting of more than 20 to 25% of the outstanding shares is considered large. In the journal entry for a large dividend, retained earnings is debited for the par value of the shares on the declaration date. In this example of a small stock dividend, we have Fuji Company, which has 100,000 $1 par common shares outstanding. It declares a 10% stock dividend. A 10% stock dividend means it will distribute a quantity of shares equal to 10% of the quantity of shares outstanding, which would be 10,000 shares. By increasing the number of outstanding shares, the company should expect the market value of the shares to decrease proportionally. Before the dividend, the shares are trading at $22 each. If the number of shares increased by 10%, the company expects the market value to decrease by 10%. Considering this decrease, the shares after the dividend would trade for $20 each. This is the value to use in calculating the amount to debit to retained earnings. 10,000 shares at $20 per share is $200,000. The journal entry also consists of a credit to an equity account called stock dividends distributable in the amount of the par value of the 10,000 shares, which is just $10,000. The excess is credited to a paid-in capital in excess of par account. On the date the stock is distributed, the equity account stock dividends distributable is decreased with a debit, and the actual shares are issued, recorded with a credit to common stock. In this example of a large stock dividend, Fuji Company declares a 50% stock dividend. 50% of the quantity of shares outstanding would be 50,000 shares. In the case of a large stock dividend, it doesn't matter what the market price before and after the dividend is. The journal entry on the date of declaration consists of a debit to retained earnings for the par value of the stock, which is 50,000, and a credit to stock dividends distributable. Alternatively, paid-in capital in excess of par may be decreased with a debit. On the date the stock is distributed, stock dividends distributable is decreased with a debit, and the actual shares are issued, recorded with a credit to common stock. A stock split is a reduction in the par or stated value of each share. The total number of shares outstanding is increased. A stock split doesn't affect total stockholders' equity, so nothing is formally recognized in the accounting records. A liquidating dividend is a cash dividend that represents a return of a stockholder's investment back to the stockholder. Instead of debiting retained earnings, the debit is made to paid-in capital in excess of par. Recall that paid-in capital in excess of par is part of the contributed capital section on the balance sheet, whereas retained earnings is not. Here's some practice problems to try from the textbook found at the end of the chapter. I recommend you pause the video now, work the problems, and then resume the video to see the solution. Presented here is the solution to practice problem 13.12. Remember that mandatorily redeemable shares are treated like a cash loan in which a liability and related interest expense is recorded. At the end of the first year, $80 of interest accrues. Now the liability is $1,080. In the second year, $86.40 of interest accrues, which is based on the new liability balance. Finally, when the shares are redeemed, the liability is reduced to zero with the debit. Presented here is the solution to practice problem 1313. Like with mandatorily redeemable shares, put options are recorded as liabilities. The options are revalued every year, and the liability account is adjusted to the revalued amount, with a gain or loss being recorded to offset this adjustment. When the option is exercised and the company buys back the option holder's stock, treasury stock is debited for the market value of the stock on that exercise date. The liability is reduced to zero with a debit, and in this case, a loss is also incurred because the liability account only had a balance of $350, but the final value of the options on the exercise date was $400, the difference between the market value of the stock on the exercise date and the stock value for which the put option was written. Presented here are the solutions to practice problem 1316 and 1317. 1316 is fairly straightforward, with a debit to retained earnings and a credit to cash dividend payable liability on the date of declaration. For problem 1317, retained earnings is debited for the market value of the property on the date of declaration, which in this case is $270,000. The liability account property dividends payable is credited for the carrying value of the property. The carrying value of the stock is $200,000, which can be determined by multiplying the number of shares times the price per share on the day the company purchased the shares. A gain is recorded because the market value of the property is greater than the carrying value. Presented here is the solution to practice problem 1318. The amount to be debited to retained earnings is determined by multiplying the number of shares to be distributed as a dividend by the projected market price of the stock after the dividend is distributed. Pause the recording if you need to review the details of this problem. Not all gains and losses are reported on an income statement. Some are not considered to be a result of ongoing business operations and bypass the income statement, but are reported in another statement called the Statement of Comprehensive Income. Comprehensive income is equal to net income from the income statement plus several other items that are in a category called Other Comprehensive Income. You'll learn about these items in more detail in future chapters. At this point, it's important to be able to identify those items that belong in Other Comprehensive Income. These include adjustments made due to changes in foreign currency, unrealized gains and losses on securities classified as available for sale, unrealized gains and losses on derivatives, gains and losses related to pensions, and prior service costs or credits related to pensions. Shown here is Apple's income statement for 2013. It has the usual elements of sales, cost of sales, operating income, and net income. On the next page is the Statement of Comprehensive Income. You can see it begins with net income, then has a section for Other Comprehensive Income, which details some of the items you just learned are to be reported in this section. We have foreign currency adjustments, items relating to derivatives, and items related to available for sale securities. The Other Comprehensive Income section is subtotaled, and total comprehensive income is shown as the sum of net income and the other comprehensive income or loss. Accumulated other comprehensive income is a line item on the balance sheet, reported in the equity section. The amount of other comprehensive income for a reporting year from the Statement of Comprehensive Income is added or subtracted from the accumulated other comprehensive income balance from the beginning of the year. Looking at Apple again, notice that the total other comprehensive income for 2013 was a loss of $970 million. On the next page we have the balance sheet. If we look at the bottom, in the equity section, we can see that the previous year's balance in accumulated other comprehensive income was $499 million. If we net the two amounts, negative 970 million, and positive 499 million, we arrive at negative 471 million. As you can see here, this is exactly what's reported, a loss of 471 million for the year ending 2013. So this concludes the video for Chapter 13. I haven't covered every item in the chapter, so please be sure to read it and let me know if you have any questions.